This year, Horwath partnered again with Bank Director to learn what bank leaders think about the current state of bank M&A. The 2016 Bank M&A Survey reveals that 67% of responding bank executives and directors say their bank needs to grow significantly in order to compete today. And the majority also believe the current environment is more favorable to M&A, with many saying that more banks wish to sell. A review of announced bank M&A transactions for the first 11 months of 2015 reveals that most sellers, at 48%, are banks between $100 million and $500 million in assets, followed by banks with less than $100 million in assets, which account for 34% of transactions, according to S&L Financial. Data from S&L also reveals two key factors prevalent in comparing banks with assets below $500 million with their larger counterparts: growth in loans and deposits and the levels of fee income. Lack of growth often has been cited as one of the main reasons for a bank's decision to sell. In this year's survey, we were able to capture data from executives and board members who had been involved in the sale of their bank. 27% of respondents cite limited growth opportunities as a reason for the sale. 55% cite desired shareholder liquidity. It may be that boards have focused more on qualitative issues in the last few years and less on quantitative reasons. Shareholders desire liquidity, but in many cases, board members and executives will say that they are tired and that banking is not as rewarding as it had been at one time. Banks of all sizes appear to be earning adequate levels of income. I suspect that these other issues are driving sales and are probably most earnestly felt at smaller banks. Size has certainly influenced acquisition activity over the past few years. Is there a right size for the industry? 32% of survey respondents say $1 billion is the right size, and 22% say $500 million. What does appear to be an overarching theme is that no matter what size a responding bank is, they mostly believe they need to be larger to compete. Despite lower growth prospects and income levels, banks with assets between $100 million and $500 million have fared well over the last 3 years. In contrast, banks between $1 billion to $10 billion in assets have experienced good growth in their markets, have reasonable levels of profitability, and have also established strong lines of fee income. So who's best positioned to make a deal in 2016? A fairly broad rule of thumb would be that many acquirers look for transactions that are somewhere between 10% and 20% of their size due to the cost of the acquisition and the impact on their capital ratios. Since the majority of banks selling are below $500 million in assets, the likely buyers are going to be in the $1 billion to $5 billion asset category. In 2015, these institutions have been among the most active acquirers. However, I believe that size is just one requirement. A bank needs to have adequate capital and resources to be able to acquire another bank. But what I view as being more critical is organizational maturity. Are the acquiring bank's processes and systems ready to acquire another financial institution? This includes the ability to successfully integrate the acquired bank's operations into yours, along with a well-defined enterprise risk management process. If, as an acquirer, you have yet to exhibit strong performance in risk management, the regulators often won't give you the benefit of the doubt. Only time will tell what size a bank needs to be to survive, but we should continue to see steady and consistent M&A activity in 2016 at a pace of about 3.5% to 4.5% of banks consolidating. Join us again in the fall of 2016 as we once more survey bank directors and executives to provide you with insights into the current bank M&A market.